Who has...
live.
We are live.
Hey, everybody. Welcome to Ask Me Anything. We'll be back in 14 seconds. Just get it going. Awesome. Take it away, Steven.
well done, Mr. Fouts. I didn't know you knew how to press the button. I thought we were just going to go live. So we're back. Ask Me Anything. I don't see a lot of questions, so we will just go around the horn, introduce ourselves, tell you who we are with the purple bottom PMC money tank in Dallas, May 8th and 9th. Don't forget to get your tickets. Come see all these fine folks there. I don't think I'll be there, but I know they will be. So let's go over. I'm over here in Orlando, Florida, and over to my buddy, Craig Yenny.
Good afternoon, Craig Yenny here. I hail from the south part of the Denver, Colorado area. And anyway, just excited to answer your questions, so let's get them in the chat. But before we do that, let's go talk to Brian up there. Hey,
everybody. Brian Fouts here. A lot of calls today. I think I have 8 or 9 calls today. So it's been a busy day. Yeah, finally starting to get some warm weather. We have no snow on the ground now, finally. So I'm very happy about that. So Jason, I know that's your favorite thing is snow. So yeah.
Only if I got skis on, Fouts. Only if I got skis on.
And I don't ski, so it's kind of funny that I live up here. But with that being said, Shauna?
Yeah, Brian, you want to know something funny? So you were in my, I'm going to say nightmares a couple nights ago because I had a nightmare where I was like walking on ice and then I fell in the ice and then I couldn't get out and then a grizzly bear was coming and somehow Brian Fouts was there. And luckily I woke up before the bear got me, but I woke up at 2:00 in the morning and I was just like, I'm not going back to bed tonight, but
wait, was Brian Fouts the grizzly bear?
Was I?
No, you were, and he was like somewhere safe, and I was like trying to get to where Brian was, and then luckily I just woke up, and it was one of those where I was like, "All right."
You were a savior. She thought of you as the mountain man who could save her. That's good.
I thought maybe I was riding the bear or something, but actually, it's kind of funny. We're actually we actually go bear hunting up here where I live, because the last bear my neighbor got was about 100 yards from my house, so we're hoping to see if we can get one this year too.
Okay, well, maybe I'm somewhere there in my sleep or something. I don't know. But Bree, is that the office that behind you?
Maybe.
No, just don't let her move too much. Then her arms will disappear.
Yeah, right. Just parts of me will go away.
Yep.
I'll pass it over to Bree.
Hi, everyone. So I'm Bree Shaw. I'm, as my title says, HELOC Joe's warden on his calendar and his better half, if you will. And I'm actually based here in Alaska. So I've been a part of the team, I think almost coming up on a year now, right?
Wow.
I've been doing IBC since, for 3. So, and then the HELOC strategy a couple months in. Happy to answer questions and share experience.
That's awesome.
I don't know who's next. Or if I was
Don't forget Mr. Snaggy.
Who are you?
What's up, guys? Stephen Nate here. Happy to help. Sorry, I was on a phone call at the start of this thing. So looking forward to answering your questions. I see a couple people over in the chat that were on Wealth Webinar earlier. So had a really good show earlier. If you missed that one, check it out on YouTube at the Chris Noggle. Here in a couple days, it'll be posted up and ready to rock and roll today. It's fun.
All right, I'll start with Joshua's question. So is my train of thought correct in thinking it's the best to go tax exempt for 2025 and paying my tax liability before April 15th, 2026, since I have a first lien position HELOC? This might be an add-on. So as a side note, I am almost double my base salary with overtime over the year, so paycheck amounts can vary widely depending on overtime given a 2-week period. How do you go tax exempt?
Yeah, I'm not understanding the tax exempt comment. So, I'm not understanding how the HELOC rolls into it. So I'm not quite understanding that question right there. So Josh, if you want to maybe clarify it in the chat for us, that would be helpful. I'm not sure how you.
Look who decided to show up.
No.
Wait, who let him in?
I had to take Ariana to lacrosse.
There you go.
Can we? What was the beginning of the question?
Wait a minute, lacrosse. We can't be messing with her arms, right? I mean, are you okay?
That'll be on Monday. That Junior Olympics on Monday.
All right. Where we
This is the question there, Joe. Yeah, so we're not quite certain what Josh was referring to when he says tax exempt for 2025 and paying liability before April of next year.
Since he has a first position HELOC.
I don't know what the HELOC has to do with it.
Right.
I think that's what we're after, is just maybe some more clarity from Josh on what he's asking.
So if you double the salary, then it sounds like he's going to have a larger tax bill coming up, but it depends on how you're paying taxes now. Are you paying them, out of the paycheck, so they're already taken care of, or is it paid, another way?
Is his thought like the HELOC is like an expense of some sort, like that would maybe offset your income, but that's not a thing? Like that's the only thing. That's the only way I can make sense of this conversation. This comment.
I don't think so. That doesn't make sense. Anyways, if you can clarify.
You can clarify.
None of us here are accountants or CPAs or financial professionals anyhow. So, but we'll do our best. So.
Okay, here's follow-up questions.
Okay, taxes won't be taken out of my check if I am exempt, so I get much more money into the HELOC every 2 weeks. Oh, I see what he's saying. He's wanting to not pay taxes on his paycheck so that he can put more of his paycheck into his all-in-one.
No.
Okay.
You got to be very careful with that, though, because if you don't pay taxes all year long and then you have a big tax bill that you pay, they'll ding you for that. So I know a lot of us have had to deal with that. So that's why we do quarterly taxes. So you could actually opt out, do quarterly, and then roll that tax into the HELOC, and then when it comes time every quarter, you can pay it out of that. I mean, but that's kind of a personal choice. You'd have to run your own numbers on that one.
Yeah, he's saying, for example, I made $9,800 on last paycheck, but only brought home $5,400. So just trying to get more of that in that.
Yeah. I mean, it depends on what's coming out and how, the employer and how they do taxes and what your options are. But, once again, we're not a CPA, but that definitely would be a good question if you have a CPA to ask them about that, to make sure that you don't get into, any trouble with the IRS.
Well, you won't get in trouble. You'll just be paying, like Antonio says here, under reporting, you're going to be paying
Slapped on the wrist.
If you don't either withdraw the taxes on from your paycheck or pay estimated tax payments throughout the year, they're going to throw a penalty at you.
Yeah. Which is what I'm dealing with right now.
Okay, Justin said, I saw the webinar this morning. Oh, that got dropped on Sunday about HELOCs, and Brian and Joe elaborating on it with the illustration. It finally clicked for me. So thank you guys.
Awesome.
Good job, Justin.
Yep. That's what I always say. We always say there's a point at which it clicks, all of a sudden, oh, okay, now it makes sense.
I don't think we have any questions right now, right?
I don't see any.
Yeah, so that's what they're talking about right there. So Eve had looked it up. Income taxation is theft. Yep. All right, guys, get those questions in. Any other questions you guys got? Otherwise, you're going to hear us start talking and randomly about random things.
I think Stephen and I answered 6 million of them on Wealth Webinar today. So
We did.
a lot of them.
I'm sorry I missed it. I wish I was there.
You guys took up all the questions, man.
Took them all.
What were they? Start there.
Do a recap.
Well, I mean, a lot of it was how do you pay loans? Let's see, what else do we have? Am I too old for this? I mean, Stephen, there were just so many. Someone said they talked to somebody about infinite banking and they were told to use an IUL, so we blew that one up because we don't want IULs for infinite banking.
Yep. I've got a question here.
Hey. That's what I like to hear, Christian.
Mhm. Okay, Dr. Cheryl is saying, might it be worth it to pay the penalty for not paying quarterly taxes so that more is invested in the year?
Ooh,
Depends,
that's a good
Cheryl.
question, Cheryl.
Yeah, it depends on the numbers. I mean, bottom line is, do you want the IRS, looking at you more closely or not too? It's always a consideration, because if you're doing that every single year, I mean, that's going to raise a red flag for them.
Yep. Always boils down to, what do the numbers tell us?
Chris is in the air right now. I think he's flying, isn't he? He's on the plane right now.
Yeah, Chris is on his way all the way to Napa, California for a boardroom with Kent Clothier.
Thanks.
And then Dr. Cheryl Lentz is saying, what is the tipping point?
Are you losing money?
It's just, it's just money. I mean, if you're losing money, then that would be the opposite of what you want to do.
Yep.
So
I know what she's saying.
yeah,
So the penalty is going to be $900 for not doing quarterlies, but by not putting in that $200,000 a year in quarterlies, wouldn't I be making more money on my $200,000 and putting it to work and paying the $900 fee? Correct.
Right.
But we're not CPAs.
Yeah. And I've never asked that question. What would happen if you did that every single year and paid that penalty every year? Would the IRS eventually kind of say,
well, it's year 4. I'll let you know what year 5 brings.
there you go. I've never known anybody that's done it for longer than that. So, all of a sudden, Joe's not here. Where'd he go? Well, he's in jail.
Christian Omar is saying, my homework is done. What's your calendar link for Joe?
Joseph.beyourownbanker.com.
Okay, here we go. We got some questions. How would I be able to find out if someone has a life insurance policy out on me?
Well, they would have had to have gotten your permission, or you'd have to go through the application to do it. So,
Well, I mean, if they got out when you was a kid, maybe not.
Yeah, unless you were a kid. That's actually a good question, because we talked about that before, where they estimate there's, what is it? How much in death benefits out there unclaimed because people don't know that there's a policy out there? It's some crazy, ridiculous number, where like someone gets a policy on someone when they're a kid, and then 60 years later they pass away, but they forgot they had that policy and the premiums were paid up. So if it's not known, then if the insurance company doesn't know how to contact that person, I mean, yeah, it can happen. So, but anybody know the way that you can find out if you have coverage on yourself?
Not.
If you go for a policy, is there a way that the insurance company checks to see if you have anything else in force?
They will look at further in force. I don't know if they share it or not, unless it came back to be an underwriting problem. Like, hey, you're carrying too much insurance. I haven't really gotten notification otherwise. So,
yeah,
we're stumped for the first time ever.
Yeah. Well, the follow-up question here is pretty interesting. So, what if my ex-husband forged my signature? I mean,
this is taking a twist.
Yeah, but it wouldn't, like you mentioned, Brian, I think there's still a medical exam on the person.
Check with the MIB, the Medical Information Bureau. Visit MIB.com and look for the request your consumer file. And once a year, you can do it for free.
Yeah, that'd be the best way to do it. I've heard it before, but I've never done it before. But yeah, I mean, if someone could forge a signature, I guess, and somehow get a policy in place. I mean, like, keep it in mind that the other thing too that you check, and I don't know how they check on this, but the bank account tied to the policy is supposed to be in the policy's owner's name.
Mm-hmm.
So that's also another. But if a husband does that and forges someone's signatures and they're the owner, then they can essentially bypass that whole Yeah.
It was like a chain of custody with that. I just had someone where they were using the wife's account to fund the policy, and so they had to resend the documents for like a chain of custody to do that. Steven, spell fiduciary.
No.
Are we fiduciaries? Knights of Israel is asking.
No, we are not.
I was thinking of making a funny there, but I decided not to.
Oh, is it dad joke time?
Always. When is it not?
Saying fiduciaries care more about the commission, but I didn't go there.
Justin saying, I assume with a mortgage and a HELOC at the same time still works, but with it just being a HELOC, would that make everything a better system wise? Is that why you guys do it? Yeah.
For more efficiency and to get out of the
Amortization.
Yep, the amortization with the bank.
Okay.
You're
Jay
climbing the ladder,
Bone,
Justin. You're climbing the ladder.
he'll be in Dallas too, so you guys will be able to meet.
Yep.
Jay Bonehead is saying, if I have say 20,000 in my IBC policy and I have a first lien HELOC with a higher interest rate than the interest rate on a policy loan, would it make sense to take a policy loan into the HELOC?
It can.
What are you doing with the money?
But
No,
yeah,
it's the same thing.
but it depends on what you're doing with the money. I mean, if you're just looking at it from a pure interest perspective, then yeah, it can. It's just where you park your money. We'll park it where it incurs the least amount of interest. But as Joe said, what are you doing with that money? I mean,
It looks like he would just be reducing an interest rate that he's paying. So he's got money out of his HELOC right now, it sounds like, with a higher interest rate, and he's trying to move the Band-Aid, plug that hole.
That's how I do it. Yep. And I think
Yeah.
I'm pretty sure that's how Joe does it.
Well, I don't park my money anywhere.
No, that's true.
correct.
Yeah. Velocity of the money in motion is what makes more money. So it's easier to keep it in your HELOC, right? Where that's your savings, your checking, and your investing account. That's your little one pot system, the nucleus of your banking system. And you run it through your policy to capture it, have it earning and working for you there and being protected, but then stick it right back in the HELOC, ready to go for your next opportunity.
Correct. And it don't stay there very long either.
and even minute, holding the money in the HELOC rather than the policy it's just arbitrage. Yeah, I mean,
Yep.
Like if you're just like holding on the cash right now or keeping things, not in investments because you're wanting to see what happens in the markets, wherever you park it, yeah, for sure.
The way that I explain this is that the policy is the asset from day one. The HELOC is the liability until you move the money to make arbitrage. So it doesn't matter if the money is in the policy or not. You're still making money on that money, but by being in the HELOC, now you're actually not paying the interest on it. In the policy, you have the dividends and interest kind of negating the interest in the policy. So therefore, the HELOC is the 100% liability that just it's not paying you to use it. So
the answer is kind of park it in the HELOC, but then use it.
Use it. Pillar 3, money not in motion.
Don't
does not
park
make
it.
money.
Yeah.
David saying, would it be possible to get a small overview of qualifications for a first lien HELOC to buy a property?
I pre-qualify everybody. I run through their numbers. I see what the debt is.
And we just did a client call today, and I'm working on some little worksheets that can be used so you guys can see visually, mathematically, even when we're off the phone.
Yeah. I'll do a strategy call and run all the numbers with you and see what the purpose is, what problem are we solving, and hold your hand through the whole process.
Okay. Justin saying, Brian, when do you think you're going to start that system and record it without not having a HELOC?
I'm doing a new policy, so it'll probably be 45, 60 days to get the policy set up, and then I'll start using it for that one. What he's referring to, for those that obviously nobody's talking about, is I'm doing what Joe's talking about. Joe talks about doing it with a HELOC, velocity banking, essentially, for knocking off debt. I'm doing the same thing, but using a policy, cash value policy, to do the same thing, because we're using a line of credit, revolving line of credit, like a HELOC, but I'm using a policy to do the same thing to recapture and pay off debt. So
that's what Brianna did.
Yep. So I'm going to record that strategy and how I'm doing it, to kind of show people that this is how it works. It actually does work this way.
When's the last time you guys backed up your phones?
Never, probably.
All right, Fouts, you and me, same boat. Anybody else? Joe, do you know how to use your phone? Back up your phone.
Whenever I wake up and I see the little apple on it, it says, "Oh, you had an update."
No, I don't mean updating
it. You're getting technical there, Jason.
My bad. I've just had the poor, like I was sharing before we went live. We have Joe, his name is. He's been a saint with us all day, and you know how it was actually reminding me of how we provide white glove service for people and solve their problems. So the last 3 days, our internet's been down, and it's been pretty wild. Like, I didn't know, hey, 26 years on internet, no big deal. 3 days, and I'm about to lose my mind. Working, helping, can't really do a whole lot, right? And so then we had them replace the modem, the router. Happened twice. Happened on Sunday at 7:50 in the morning, and then happened again Monday. And then finally, we're like, forget it. AT&T just ran all the fiber in our neighborhood. We'll call AT&T. And this nice young guy comes in. He's like, hey, I'm here to make sure your fiber is installed properly and show you guys how to use the app and everything. And, oh, I see you're with T-Mobile. We've been with T-Mobile like 20 years, right? And so he sits down with my wife. I come in. She's writing everything down. He has her writing everything down, taking notes, answering her questions, showing us how much money we're going to save, how we can upgrade our phones, how it's all going to be this. The guy didn't know that I haven't backed up my phone since 2016. He's been trying to back it up. Now he's been here for like 4 hours. I think we just bought him some pizza. I'm like, will you please get Joe like something? He's literally been at my house since like 9 o'clock this morning.
I don't think I've owned my phone
8 hours. But we have fiber now, and I've got a new phone that I probably don't know how to use, and I don't know how to back up, but they're going to set it up so it happens the right way. So,
just schedule a call with Joe HELOC. He'll show you how to use the phone.
Oh my God. Fouts, when you made the video play, I was like, how do you do that? That's so cool.
All right. I got some more questions rolling in. Shauna just disappeared. So technical difficulties on her end, I guess. All right.
Can you guys hear me, or is it choppy on my end? Because you guys are all road body and it's not working.
I can hear you
fine. All right.
All right. SB Hack says, does the interest rate change on loans with Lafayette? Yes. At the anniversary
any carrier, it can. Yeah, any carrier. So
typically at the anniversary of your policy, so once a year, it changes to the current rate. Is it determined when the loan is taken out and stay fixed on each loan, or recalculated yearly on the amount that you have outstanding? So yeah, so it's whatever loan balance you have is what that rate is going to be charged on. So if it updates from like 5% to 6%, and you have a balance, then now the new balance is going to be at 6%. So,
simple still. It's still simple interest.
Yep. Not complicated, just simple.
Yeah, stupid simple, like simple. So.
Yeah. All right, Brent. Traditional mortgages have amortized interest switched to first lien, HELOC, and everything switched to simple interest. Yep, that's exactly what it does.
Here's a fun question for you. So, Gabe Rentana, who you guys all know, right? We all love Gabe, and we have to because he could beat us all up with his 6-blade jiu-jitsu. But he bought a farm for $684,000, and the interest was 8.64%. Over 30 years, what is the total interest paid in percentage? I figure it's asking me anything. Let's start asking the audience questions and see if they can answer with us.
42.
42.
I say about 163.
Holy smokes, folks. He knows his stuff. 164.
Oh my, look at that.
164%.
Nailed it.
You didn't even click and pop out loud. That was impressive. Craig, what happened, man? I can't believe you were 4 times off like that.
I don't know if I believe that number. What's the
Here, I'll send you Gabe's text to me. So of the numbers. I have it saved.
well,
You know,
No way, I don't
sometimes
have a phone
impress
yet.
myself.
I will send it later today.
well, just tell me what the numbers are again.
Hold on. It was 684,000 and it was at 8.64%
For 30 years?
for 30 years. And the total interest paid. Oh, sorry, it's I lied. It's 8.385% and it was 679,000. And then since we don't like dead air time, I'll keep talking. So we have, so we don't have dead air. We're all watching Craig do some math. Here's another question for you guys. So I play this. I've been playing question games. I don't know how you guys are running your calls, but I keep trying to make mine more interesting, get people to think. So I notice a lot of time people are excited, they want to move forward, and then they don't really understand. And so, like, how can we get people to think? So a question, and now all you guys know the answer. So let's see if the audience chimes in. So we're going to assume that we have $44,000 in cash value, okay, in a policy that we can take a loan, a simple interest loan. In scenario A, we have a $44,000 car payment or car loan that is at 7.6% and is $850 a month, okay? Now the question, I'm going to give you 2 scenarios, and at the end, you're going to tell me which scenario you're picking and why. In scenario B, we have the 44,000 and we've decided that we went to Private Money Club. We met someone that was doing a development. We really liked them. We got to know them. We liked the project and they're going to give us 12% and they're going to pay us annually, but they're going to pay it out monthly. Okay. So that's 44 grand at 12%, $440 a month that we're receiving in interest. Our money's now making money. Which scenario are we picking and why to use our money for? Let's say Brent, anybody, Steve, Jody, Eve. This is ask you anything. No longer ask us anything. It's now ask you anything. We've changed the show, Stephen.
The tables have turned.
I like it.
We're going to start bringing questions for the audience.
Okay.
Okay.
Brent, you should answer this. You know the answer.
You know the answer.
Yeah,
know
we're
the
all
answer.
Joe's minions.
Shauna knows the answer. Shane, Navigate Your Ventures, knows the answer. I know this crew knows the answer. And the fascinating thing is that only one person out of like 14, there you go. See, Christian answered what most people are answering. Most people are answering B because they feel like they're making an investment and they're making 12%. What I'm looking at is cash flow and no risk. If you can take over the loan, the valuable loan the bank has, and you're collecting $850 a month, why wouldn't you do A? There's no risk. It's $850 a month. It's almost double the amount of cash flow, and it's all coming back to you at the same simple interest that you're borrowing from an insurance company. Right? Because I get almost everyone tells me B because your money's making 12%. It's more than 7.6%, and it's your money making money. Joe, any comments? Mr. Helock?
So I guess I missed how much the car payment was. So the investment is less than the car payment?
Yeah, the car payment at 7.6% was $850 a month.
Okay, I was thinking the way that I do it, and so I would take the money out of the policy, put it into the investment, and then when the investment comes in, that investment pays the car. I didn't know it was half the price. So
yeah, if you could do that, then yes, then you'd have your investment pay for the things that you're buying. That's what Kiyosaki talks about, cash flow. But I'm looking just
in your situation, it would be A because there wasn't enough in the investment to cover the full price of the car. So then A would be the beneficial.
And A, you end up with twice as much cash flow at the end of the year coming back for the same interest that you're paying on the $44,000 loan.
If you were to, yeah, because you were doing A. But then in B, if that was coming in at 800 instead of 400, now your money is working A in the policy, B in the investment, and now the interest is covering the vehicle. So then that would win on that side. Yeah. No, but because it's half, you are correct.
But we're looking at cash flow, or we're looking at cash flow and A. And the reason I'm asking all of you this, to ask you anything, is because we're not looking at our debts as a potential asset. Like the banks gave you a loan. Why? They didn't do it because they thought Snaggy was pretty. They're like, hey, Snaggy, buy another truck, buy a boat, buy a thing, right? And we'll give you this percentage so we like you and we want to hang out with you. No, it's because they make a lot of money.
Mm-hmm.
And then we were just talking about the amortized interest. That shows you that that's not a real number, because if at 12%, it's half as much. Like Joe said, well, hey, if you got double, well, then you're at like 24% return to get equal to what 7% is.
Mm-hmm.
So don't look at the interest rate, folks. Look at what the cash flow is actually doing.
So we have a lot of questions stacking up.
Yeah.
Good. Let's go.
And then, Antonio, we see your question too. We'll get to yours here in a second. So Robert said, why is it recommended not to run your regular everyday expenses money through your policy? Maybe you want to take that one?
Yeah, I mean, from my perspective, there's a lot of other things you could do with it. So instead of buying groceries with your policy, why not put it to work? Why not, pay down debts? Why not finance your major purchases? So it's just not the best way to do it. And it takes a kind of a mature policy before it really works to run expenses through it.
And I was going to say, it's probably what Craig's saying, and make it a little easier. If you're using your policy, you're paying interest to buy groceries, and then you're paying back the simple interest. You're not earning anything. I mean, you are earning money in the policy. It is protecting your family, but it's not really making you a big enough spread to really make the math make sense until it's more mature later on.
Yeah.
Like mine now, when I put my deposit in, I take out more than my deposit. So if I wanted to utilize that for daily expenses, now I'm making money on my money by doing it that way. But until the policy becomes efficient, it's better not to.
Yep. All right. Justin said, with HELOCs, are you ever scared that they reduce your amount, or is that just a rumor and it doesn't happen? I'm just hearing that from people.
I've been doing it since 2010. I keep almost the maximum on it on a daily basis, and I've never had a problem yet.
It depends on the lender too. And there's reasons why they might lower your HELOC balance or lock it up. I've had it happen to a PLOC for me, and a client just had their HELOC locked as well recently. It's because their credit score changed. It dropped like 100 points. And so the banking institution got notified of that, and they locked the HELOC down. So that's a scenario I've heard it happening, but it depends on the banking institution. So Joe, I think you've said that one of the ones you use, they've never done that before, or they've never closed a HELOC before.
I've never had a problem with any of my HELOCs in the last 15 years. But my question to you is, did you have 100,000 or, a good amount in your HELOC that they dropped it down to that amount?
No, it was a client, so they had a balance on the HELOC. What they did is they just closed it out so they cannot borrow from it anymore.
Wow.
They locked it. You still got to pay it back, but you can't use it anymore. The same thing with my personal line of credit, a PLOC. I have a balance on it. I have it still right now, which is frustrating because I can't use it now, but they locked it. And I don't know why. There's no reason. They just decided, hey, we're not going to let you borrow from this anymore. So now I got to pay it all back, but I can't use it for actually Velocity Banking now, which is frustrating because that's what I was using it for.
I mean, wouldn't that be the risk?
Second lien HELOCs and the first lien HELOCs are different animals. So with the first lien HELOC, like I'm opposite of Joe. I'm teetering on having my HELOC paid off again because I don't want to put any more money out there right now. So the question I've asked of CMG and North Point, who I use, is since I'm more or less paying all of the HELOC back, is there any risk of you shutting my credit line down? They said, well, they could, but they've never done it before. And the only time they would do that is if they saw that you had issues paying your bills. But I think with a second lien HELOC, and Joe, I don't know if you've had more experience with seconds. I haven't used them in the past, but what I've heard on seconds is that if you don't have the money utilized, they can take that credit away and shut that piece down. But on a first lien HELOC, I mean, it's a 30-year mortgage.
Well, that's why I asked, did you just have $100,000 sitting in there? And they're like, oh, you don't need it no more. So you dropped your 300 down to 200 and you're like, oh, now you just have 200 to use.
Yep.
That's
I mean,
I like
all
to keep
these
mine maxed out.
guys, in all these situations, isn't the bank still in control? Even though you've traded amortized interest for simple, isn't the bank still in control of the contract and what happens?
I'm using it for leverage. I'll gladly pay the bank 6-8% to make 24.36.
I'm just saying, like,
isn't
at the end of the day, like if that bank decided to make that change, it's still in the bank's ability to do so. That's all I'm asking.
True.
I don't know. From my perspective, I mean, if you have a traditional mortgage and you're prepaying that, you have no access to get that money again unless you refi but with the first lien HELOC, I do feel I'm in control because I can prepay it, I can take it out, I can prepay, I can take it back. I'm on my fourth cycle of paying the house off. Who's in control? So how much money has my house made me in the past?
Lots.
A lot.
More than you paid the bank. That's how I do it.
I mean, I just saw with my mother-in-law's mortgage, it just went up. They claimed, escrow was off. And it's like, well, no, it wasn't. But even why are they making you do escrow? Think about that. Like, no matter what, the banks are trying to be in control. That's why we have to know what to do with the money while we have access to it and how to leverage it. And that, like Craig said, that doesn't happen with the mortgage. So I'm happy as a clam these first few months into the HELOC.
All right. Navigate your ventures. Another question. PMC question. So private money club related. Completed lending certificate. Would you recommend the introduction to contract law or the borrower certificate next? I'm not a borrower at this time. I don't know. Maybe I haven't.
I'm trying to think. I went through all the lending pieces, but I don't really remember. I think when I first took it, I think it was all one big course. I think it's broken up now. So I don't know. I'd have to go back and look.
If you're not a borrower, then why would the focus be on the borrower certificate if you're not a borrower?
Yeah.
Contract law probably the first one then because you're not a borrower. So.
Yeah, I mean, I think the perspective there is just good to know what the lenders and the borrowers are doing on both sides, just to understand the whole equation. But yeah, I don't think I took the borrower's piece.
And Shane, I would just ask you, like, what's your outcome, right? Like, whenever you're looking to add a new skill set, is there something that you're growing towards that would give you more insight to what you're doing, what you're running, or is there something else that you could sharpen the saw in a different direction that would help you maybe accelerate a little faster in what your focus is today? Like, that would be my question for you, and looking to because your most valuable resource is your time, your energy, your focus. So what are you putting that towards?
All right, Antonio, another question here. I'm currently in a situation where I had to reduce my annual premium down to the base and add to the LPUA when I can. However, I don't see that the LPUA is giving me any available cash to borrow from.
When I read this, I'm thinking he maybe have the base and the LPUA turned around, because if he went down to the base, that's all he's paying. So there won't be any LPUA. So the base typically doesn't have cash value early on.
Well, if he's keeping the PUA at $10 a month or whatever, there won't be. I mean, there'd be a little bit of cash value, but you have to have a certain amount before they want you taking a loan. Maybe.
It depends on. I mean, so let's say if your premium is $10,000 per year, your base is say $3,000, and you're only paying $3,000 right now, not the PUAs, then you're not going to have any cash value growth based upon your premium. But if you're doing let's say you say, okay, now I've got $1,000, you put $1,000 in, make sure it's going to the LPUAs or the paid up additions, but that should add to cash value. If it's not, then you definitely need to have someone check on where your premiums are going. So, because we just had a conversation here recently with One America on this. If you don't put a minimum to your LPUA, it'll go away in some cases. So we recommend, I think it's $10 per month, 120 per year minimum to keep that rider active. So, but yeah, whoever your mentor is, or if you're with us, an implementation person, just give them a call and they'll walk you through it. Here, Z1G3Z. What's the best way a renter with a 37K yearly income could invest? Renter, not a homeowner. Well, invest in what you know, like, and trust. I mean,
in yourself. My answer would be in yourself.
And that's
if there's any debt, if there's credit cards or a car payment, definitely yourself, just like Jason said, to get out of debt first.
Yeah, set up your best habits right now. Like Joe's letting you know, like set up your best habits. I talked to a couple yesterday, super frustrated looking, and this might not be to you, but it kind of present, so I'm going to share it. But they made $180,000 a year. He was about to retire from the Navy, and they had $204,000 in bad debt. And they were asking me like, hey, I'm meeting with the Money Max. I'm looking at velocity banking. I'm looking at infinite banking. And what it came down to is they hadn't established the habit of just paying themselves first. Like if you're making 180 grand, you should be saving 18,000 a year. If you're making 37,000, you should be saving at least 3,700 a year. So like establish that habit first, and then go learn what you know, like, and understand. So that way, when your income grows because you're solving bigger problems, you'll be able to make that money, make more money.
All right. JB says, how do student loans factor into HELOC application? Are they more concerned with balance or monthly payment for DTI?
If it's still in forbearance, 9 out of 10 times you received a piece of paper that said that once it goes active again, there's a monthly payment. That monthly payment will be utilized against the DTI and off of the 45% off of your wages. They'll just add it as an add-on and minus that from the numbers that you're allotted for the HELOC.
There you go. All right. Jody says, hi, everyone. Hope everyone's well. My question is about parking the money in the HELOC, as you guys say. Is that only something you do only if you have a first lien? First lien, second lien, HELOC doesn't really matter.
Yeah, it doesn't matter.
The follow-up, he says, I have a second lien HELOC and can't link it like you can with a first lien to use as a checking. So if I have a no balance on my HELOC, isn't it crazy to just put my income in there with no balance? Well, you can't. If you have no balance on the HELOC, you can't put your income into it.
Right.
So, but yeah, I mean, certain HELOC companies, certain institutions do the credit or debit card tied to the HELOC. If it doesn't, then you've got to use, if you don't have that ability, most people will use a credit card and then pay the credit card off with the HELOC once a month or something like that, which is what I'm going to be doing actually, or what I've done before.
Well, my question is, if they have the entire HELOC and there's a mortgage, why aren't we chunking now?
That's what I was going to say. I said, well, why do you have no balance on the HELOC? If it's second lien, that means that you have a first lien position, which is typically a mortgage. So we should use the HELOC to start knocking the balance down on the mortgage because, as we just said here on the beginning of this call, that's interest rate is crazy. So interesting. Steve, does the interest they pay increase like the loan interest charged?
So the interest they pay.
I think he's meant dividends. The dividends that they pay increase like the loan interest is charged. Well, the loan interest it adjusts anywhere from 0 to 8% in most cases. So it has some slight fluctuation. The dividends, same, they do fluctuate, but they're pretty consistent, between 5 and 6% in most cases.
I think he's asking if the interest goes up. Usually, do the dividends go up? I want to kind of say yes to that.
That's traditionally what we've seen, because as interest rates in the market are going up, the insurance companies should be making more money because they're locking in longer term treasuries and bonds. So it's typically a lagging indicator, though, from what I've seen, is you'll see interest rates go up in the market and then later on the dividends will follow and come up. Even if the interest rates start going down, sometimes the dividends are still going up because they've locked in those rates.
Yeah.
But
keep in mind, the market's volatile. Insurance companies typically are not volatile.
Correct.
A lot more.
But the interest rates in the market still impact the loan rates that they're charging, and it still impacts the dividends that they can pay because they're, bond rates and everything are linked to that.
Yeah. I think I looked up Lafayette. I think they said their dividend 5 to 7% between that range in the last 30 years, something like that.
There's actually a really cool graph. Let me see if I can find it. I don't know if I can share out, but
I think it might be the one you shared with me. Actually, what I'm thinking of.
Yeah.
ET Phone Home says, I have a 401k parked in a stable value fund. I could close the account, incur the 20% withholding, and not making any money, but didn't lose it either. Depends on what you're talking about. I mean, if you're talking about canceling the 401k, yes, you're going to have the withholding and potentially 10% if before age 59 and a half. But if you have a 401k in a stable fund, you can always put it into cash inside the 401k. Most people don't know that you can do that, but you can just go to cash, leave it in the 401k, and then buy back in when you feel is more comfortable in the market. So, but
another thing is too, they could borrow against that 401k, put that money or pay off credit cards at 28%. And then pay themselves back to the 401k. That would be a way to utilize the money, especially if they're not making anything in the market.
Yeah.
When we're looking at this question for ET, what would you guys say? I mean, because I had talked to someone the other day I think we're getting more and more of these calls because we're seeing the market, what's happening, right? I had someone go from $700,000 in their account to $350 in a day. And so and then they went in their IRA from like 52 to 24. And he's like, well, that's my basis. I'm getting out. Like he wanted off the train. Didn't matter. Like he's over 59 and a half. And, then I'm watching like financial advisors like on LinkedIn say, hey, don't panic. Like, don't worry about the tariffs. Just stay in. You're in for the long term. And my mind is like, what do you tell these people? Because they're not really in control. But at the same time, do you want someone getting off the train when you're down 50%? But how much do you have to make back to get back to 100%? You have to make over 100%, right? When you lose 50, right?
Yep.
So, or 100%.
It's
the buyback.
Yeah, I mean, we're not advising force and all that, but that's a tough question. It's tough because if you're either being reactive or proactive. If you're asking that question, you're being reactive. You've already lost the proactive part of that equation.
Why didn't it get moved 2 months ago, 3 months ago?
We know it's all coming. I mean, people can
and
say,
these are the questions. And these are the questions because I hear you guys. I mean, you guys know, all three of you that are currently on screen know tons more than I do when it comes to financial instruments, financial things. Your thinking, your understanding of how things tie together. But I just look at it all the other things that were created as that's the game that was set up to keep you not in control, to keep you reactive. That's just how I think about it. It's like that easy. It's either you're proactive or you're reactive. And then when you're asking these kind of questions, it's like, okay, you're here right now. There's only now. How do you want it to look going forward? So do you have that person hold on, or would you tell them?
Well, I mean, if I think back to the 2007, 2008 timeframe, that's when I decided I'm done with this 401k market game. Stopped funding the 401k, started funding my first policy, and never looked back. But Brian, I think it was 2 weeks ago on WTF, you had Andy Tanner on talking about the 401k. I picked up his book. I mean, I've read a lot about this stuff, but I thought his book was really good too. So anyone that has a 401k, go search for Andy Tanner, get his 401k book, read it. And after you're done reading it, I'm going to have a question for you. Why are you still in a 401k?
Exactly.
There's another cool one, you guys, if you haven't seen it, read Unshackled. It's an attorney that teaches what we teach, but he literally goes through and shows how in a civil court of law, a 401k contract would not hold up.
No.
It would not hold up. And that's nuts. And so like we were talking about the thinking, the question I started asking people, do you know how long you're going to live? No. Oh, okay.
He does.
Yeah, they do. That's why I always joke around. Well, the actuaries know how long we're going to live within a month, right? Do you know when inflation is going to be when you're ready to go to the passive income time? Do you know what the market's going to look like? And do you know what taxes are going to be? And everyone's like, no to all those questions. Well, that's 4 variables. Like, do you want that many variables up in the air when you're trying to figure out what it's going to look like the second half of your life after working your ass off for all the years? So it's just our thinking.
And the question that I oftentimes ask people about, which is the kind of the 401k parallel, is, hey, Brian, what do you say you and I go into business together? We're going to go down and open up a bank account. I'm going to control it. You're going to fund it. What do you think?
Yeah.
Well, pick me.
I know it sounds ridiculous, but it's kind of that same vein. But
here's the book. It's the 501k written by Ted Benna, the founder of the 401k. If you want to know anything about the 401k, read this book.
Yeah.
Ted, I think Ted did, if I'm not mistaken, Joe, Ted, I think just wrote the intro to the book. I don't think he wrote that book. I think he wrote the whole intro to that book.
Well, the intro, because this is father of the 401k.
So. Well, he was the first one to really implement it, but someone else put the law into the books.
Yeah.
And I remember his name. But can I rewind back to the conversation that was asked about the interest rates and the dividends? Because I pulled up a graph from Lafayette.
Yeah, please.
Let's just go back to 1991. Mortgage rates in 1991 were about 9.25%. Guess what Lafayette's dividend rate was in 1991?
9.25.
10%.
I'll say probably 10, something like that.
So, I mean, and you can kind of see this in a graph as interest rates drop, of course, the dividend rates drop. As they go back up, dividend rates chase them. So they're always kind of in lockstep to each other. But it's just kind of cool to see kind of how those things follow each other around. And it makes sense.
I better stop asking questions. I'm 2 for 2 now. So
Yeah.
I was thinking Joe's on point today.
All right, we got a couple more to wrap up here. So Christian says, so if I have a 15K in my policy, cash value, and I can purchase a piece of equipment that makes me a big spread, how would you do it without being in a double black hole?
Why would you be, if you're financing it, you're going to be an honest banker, Christian, and pay yourself back. So I don't see how you're creating a double black hole, and it's making you money. Like, why wouldn't you do that? That's how I'm reading that.
Yeah, that would be a spread. Just a good thing.
He's not using anything with the HELOC there.
Not from what he just said. No. So that'd be fine.
I mean, Christian's a truck driver, right? So if that's something that you're doing that can make you more money, then that's, I mean, everyone, there's 2 jobs: job of making money and the job of banking. We're typically talking about the job of banking here. But Christian, if you can make more money and it's something that you're already doing and you make a bigger spread so you have more cash flow coming in, then why wouldn't you do that?
Yeah. Six says, just joined, paid off my house. What do you suggest is the best move to leverage those funds into bigger investments? Well, one, we're not financial advisors, so that would be a whole separate conversation. But I mean, it depends on what investment means to you. Like, when you think of investing, what's that mean? But we kind of talked about investing in yourself, but
to utilize the money in your 2x4s, you would have to pull the equity out. The way to pull the equity out, it's called a HELOC, home equity line of credit. Now you can take those funds, use leverage from the bank, borrow from the bank at 6-8%, put that into an investment, 12, 15, 20%. Now you have arbitrage, that's spread. And that's a way to utilize your money in your 2x4s.
All right. John says, does velocity banking process create the habit so as to transfer that practice into IBC? Looking to get started ASAP with BYOB. I mean, it's all money habits. It's all money mindset. I don't really separate velocity banking from infinite banking. They're just 2 separate strategies, but you have to have the financial acumen and knowledge to use one or the other. They both have to have good habits. If you have bad habits, don't do either one. Get the good habits first, and then you can understand those 2 concepts. But
Brian, what would you say is the good habits? Because John and I have talked a couple times, and with his wife Darlene. So he's specifically, I think, looking maybe for the good habits that you're talking about that we're looking for.
So one is just understanding where your money's coming from and where it's going. That's called a budget. That's the simplest place to start. Where's it coming from and where's it going, and get control of where it's going. Because we have control of where it comes from. That's called trading time for money or running your business, whatever it is. Be good at that, of course. But the thing that most people miss is where is it going? Because if we don't control where it's going, someone else is going to control it for you. That's called marketing, by the way. It's called being, banks, all that kind of stuff. But, financial literacy is very powerful. The first place I ever started was reading Rich Dad Poor Dad. Just reading that book. It talks about the basics of financial literacy inside that book. That's a great place to start. If you don't understand what's going on in that book, that's where I would start. But it's also assets and liabilities. Understanding what an asset is in your life and what a liability is. And understanding when you have one, who on the other side has the other side of it. So like if you have a mortgage, you have a liability. The bank has an asset. Just understanding that concept right there, assets and liabilities, is a game changer. Wealthy people focus on creating assets, not liabilities. That's the opposite of the average person. So a wealthy person or a financially smart person is going to look at and say, if the bank's going to give me financing, which is a liability to me, I'm going to go make sure I create an asset as well. So if a bank's going to give you a loan for a home, go get a rental property first that creates cash flow. Now you have an asset, and then go get a home. Like that's a different way of thinking. So that's kind of just my little soapbox thing right there.
I was going to say off of that, the top 10% own 88% of the equities just with the stock market. So that's, it's that's the huge shift. We had a client talk about it, is that they were starting to think about when they want something. They weren't just saying, oh, can I afford it? Yeah, I have money in my account, I can go buy it. They were thinking about what the payments would be or how much it is and how much they would need to invest to have interest from their, investment pay for that thing that they want. That's the shift you need to have.
And who remembers the 6 laws of wealth that Chris talks about?
Oh gosh. I don't know.
Pay yourself first. Number 1, pay yourself first. Number 2, get your money working for you. Joe talked about getting the money out of your rafters, getting it working for you.
Yep.
Control it.
3, protect your wealth. If you're not first, you're last. So you have to put your money in places you know, like, and understand. 4, someone help me.
4 is if you don't respect your money, it will flee you. Is that it?
That is it.
Yeah.
The 5th one is do something that provides value and serves other people. And the last one is be willing to pass it on as a legacy.
Love it.
I mean, I tell everybody on my calls, I have 4 pillars. Pay yourself first, be in control. Money not in motion does not make money, and spend interest, not principal.
Yep.
I like them.
Yeah.
And remember, it took Joe a long time to get there. So like everyone that's hearing this, that's impatient, like Craig just talked about when his journey started, 2007, right? 2007, 2008. Mm-hmm. So it's been a hot minute since he's been studying this stuff, practicing this stuff, building spreadsheets for this stuff. Joe's paid off his house how many times, brother? 5?
Working on 5 right now.
Okay, working on 5. Right. So just think, when we're coming here with this much certainty, talking about these things, it took a moment to get there. It didn't happen overnight.
A lot of times I fell off that ladder. I broke a lot of rungs. That's why we can help people, because those rungs that we broke and fell off of, we know how to skip to the next ladder. We already did it. So now we're already at that ladder. Just like when people say, well, should I get a second or a first? Well, if you get a first, you just went to the second ladder, because that is the next thing in line that you're going to do. If you start with the second, you're going to want to get the full value of your house in motion. So, it's that's what we do. That's what we talk about on strategy calls. What's the problem? I was going to
say, who else just saw Joe as a Mario guy climbing up ladders?
I had like 94 jokes about Joe on a ladder. So I was like, Joe, you need a stronger ladder. Why are you climbing a wooden ladder? That poor ladder. Like, I had all kinds of things. Brian has something he wants to add. He's about to come out of his seat.
No. I was just saying the last question we had there. It was just a follow up to Christian's thing. He's talking about, remember how he's talking about borrowing from the policy to do equipment for trucks and stuff, but it's a down payment. So now I understand the double black hole because he's creating his leverage as well as an addition to the policy. It's just pure math, man. So what's the payment on the loan? What's the payment on your policy loan? Make sure you have a spread there. There you go. Just math. All right. I think we got through it all.
Wow. All right.
Good job, guys.
And ladies. Even though she's floating, she's just a specter.
All righty.
Be in control of your money.
She's floating on the desk.
I was messaging and texting Christian O'Mara right now. Just
Oh, there you go.
We've all talked to Christian. He's a good dude.
Yeah,
I started with him, then Carson, now you guys. So Christian's been around the campfire for a while.
No wonder he's getting so knowledgeable. See that?
Yeah.
That's why we're around the campfire, guys.
Yeah, all of our brains make at least one brain.
All righty, guys. So that wraps up another Ask Me Anything. So with that, we'll see you guys next week. But thank you, everybody.
See y'all.
Ciao.
Bye.